Good evening, everyone. Good evening. When I look out at this audience tonight, I see faces that tell stories. Stories of careers built, families raised, challenges overcome. And I also see something else. I see people who are asking themselves the same question that kept me up at night when I turned 65 7 years ago. What do I do with my money now? What do I do with everything I've worked for? How do I make absolutely certain that the next chapter of my life isn't defined by financial worry? Tonight, we're going to talk about something that, frankly, most financial advisors won't tell you straight. They won't tell you because sometimes the truth isn't what sells products. But I've made my fortune by betting on the truth, by understanding what works and what doesn't, and by recognizing that when you're over 65, the game changes completely. The rules that made you successful in your 40s and 50s, many of them need to be thrown out the window. I'm going to share with you tonight 3 investments that you should never, ever touch if you're over 65. Never. And then I'm going to tell you about 3 investments that you absolutely must own. Must own. These aren't suggestions, folks. These are imperatives based on 43 years of managing money, of watching markets rise and fall, of seeing people make fortunes, and sadly, watching others lose everything they'd worked for. Let me start with a story. A story that might sound familiar to some of you. Back in 2019, I was having dinner with Harold Steinberg. You might know Harold. He founded Steinberg Capital Management. And Harold was telling me about his brother-in-law, Bob. Bob was 72 at the time, recently retired from running a successful plumbing supply business in Ohio. Bob had accumulated about $800,000. Not a bad nest egg, not bad at all. But Bob was restless. He was bored. He missed the thrill of business, the excitement of making deals. So what did Bob do? Bob decided he was going to day trade cryptocurrency. Cryptocurrency at 72. Harold tried to talk him out of it. I tried to talk him out of it when Harold brought me into the conversation, but Bob was convinced he could beat the market. He'd read some article about Bitcoin millionaires, watched some YouTube videos, and thought, how hard could it be? Within 18 months, Bob had lost $620,000 of his $800,000. $620,000. His wife barely speaks to him. They had to sell their house, move in with their daughter, and Bob still wakes up every morning checking cryptocurrency prices, convinced that tomorrow will be the day he gets it all back. That story, that tragedy, brings me to the first investment you should never touch if you're over 65. Cryptocurrency. Never. I don't care what your grandson tells you about Bitcoin. I don't care what you read in Forbes about Ethereum. I don't care if your neighbor made $50,000 on some coin with a dog on it. If you're over 65, cryptocurrency is financial suicide. Here's why, and listen carefully. Cryptocurrency is the most volatile asset class that has ever existed in human history, ever. I've been through the dot-com bubble. I lived through 2008. I watched the oil crisis of the 70s unfold. None of those events, none of them, created an asset class as wildly unpredictable as cryptocurrency. Bitcoin has lost over 80% of its value 3 separate times. 3 times. Imagine waking up tomorrow morning and finding out that 80% of your retirement savings had vanished overnight. How would that feel? How would your spouse feel? But it's not just the volatility. It's not just that. Cryptocurrency has no intrinsic value. None. When you buy a stock, you're buying a piece of a company that produces goods or services. When you buy a bond, you're lending money to an entity that pays you interest. When you buy real estate, you own something tangible, something physical. But cryptocurrency is backed by nothing except the hope that someone else will pay more for it tomorrow than you paid today. That's not investing, that's speculation, that's gambling. And at 65, you cannot afford to gamble with your retirement. You cannot afford to speculate with money that you need to live on for the next 20 or 30 years. The mathematical reality is harsh but simple. If you lose 50% of your money at 65, you need a 100% return just to get back to even. And time is the one resource you can't buy more of. The second investment you must avoid, and this might surprise some of you, the second investment is individual growth stocks. Growth stocks. Now, I can see some of you shaking your heads. You're thinking, but what about Amazon? What about Microsoft? These companies have made people wealthy. And you're right, they have. But here's what you need to understand. Growth stocks are designed for people who have time on their side. Let me tell you about my friend Jennifer Walsh. Jennifer ran a very successful interior design firm here in Manhattan for 35 years. Smart woman, very smart woman. When she retired at 68, she had about $1.2 million saved up. Not bad, considering she started with nothing. But Jennifer made a crucial mistake. She decided that she wanted to keep growing her wealth. She put 60% of her money into high-growth technology stocks. Tesla, Netflix, some biotech companies that her broker recommended. For the first 2 years, Jennifer looked like a genius. Her portfolio grew to about $1.8 million. She was feeling great, feeling vindicated. She even called me up to brag a little bit. But then 2022 happened, the growth stock massacre. By the end of that year, Jennifer's portfolio was down to $750,000. $750,000. She'd lost not just her gains, but she'd lost money from her original principal. Jennifer is 71 now. She had to go back to work part-time. She's doing consultation work for her old clients, working 20 hours a week because she can't afford to retire fully. And the stress has affected her health. She developed high blood pressure, has trouble sleeping. This is not how retirement is supposed to work. Growth stocks are called growth stocks for a reason. They're priced for perfection, priced for continued rapid expansion. But what happens when that growth slows down? What happens when the market decides that a company isn't worth 40 times earnings anymore, but maybe it's only worth 20 times earnings? The stock price gets cut in half, just like that. And when you're over 65, you can't wait 10 or 15 years for these stocks to recover. You can't afford to dollar cost average through a long bear market. You need income now. You need stability now. You need to sleep well at night, knowing that your money will be there tomorrow. The third investment to avoid, and this is where I'm going to lose some people. The third investment to avoid is gold. Gold. I know. Your father probably told you that gold was the ultimate safe haven. Your grandfather might have buried gold. Coins in the backyard during the Depression. But let me tell you something about gold that the gold bugs don't want you to know. Gold is a terrible investment for retirees. Here's the mathematical reality of gold. Over the past 50 years, gold has returned approximately 7.5% annually. That sounds pretty good, right? But inflation over that same period has averaged about 4% annually. So your real return on gold has been about 3.5% per year. 3.5%. You know what else has returned 3.5% over the past 50 years? Treasury bills, short-term government bonds, with none of the volatility, with none of the storage costs, with none of the insurance premiums. But here's the bigger problem with gold. It produces no income, none. If you own a dividend-paying stock, you get quarterly dividend payments. If you own a bond, you get interest payments. If you own rental real estate, you get monthly rent checks. But gold just sits there. It doesn't pay you anything. It doesn't produce anything. It just sits there, hoping to appreciate in value. I learned this lesson the hard way back in 1980. I was 35 years old, thought I was pretty smart. Gold had gone from $35 an ounce to over $800 an ounce in just a few years. Everyone was talking about gold. My barber was talking about gold. The taxi driver was talking about gold. So I bought some gold. Not a lot, but enough to hurt when it collapsed. By 1982, gold had fallen to under $300 an ounce. It didn't get back to $800 until 2008. 28 years. 28 years to break even. If you had bought gold at the peak in 1980 and held it until today, your annualized return would be about 2%. 2%, less than inflation. And for retirees, there's another problem with gold. How do you turn it into income? How do you pay your electric bill with gold coins? How do you buy groceries with gold bars? You have to sell some every month, every quarter, to generate the cash flow you need to live. And every time you sell, you're paying transaction costs, dealer spreads, sometimes storage fees. It's expensive and it's complicated. So those are the three investments to avoid: cryptocurrency, individual growth stocks, and gold. Now let me tell you about the three investments you absolutely must own if you're over 65. The first investment you must own is dividend-paying blue-chip stocks. Must own. And when I say blue chip, I mean companies that have been around for decades, companies that have survived multiple recessions, multiple market crashes, companies that have proven their ability to generate cash flow regardless of economic conditions. I'm talking about companies like Johnson & Johnson, which has increased its dividend for 59 consecutive years. 59 years. Through the Vietnam War, through the oil crises, through the dot-com crash, through 2008, through COVID-19. Johnson Johnson kept paying dividends and kept increasing those dividends. That's the kind of reliability you need in retirement. I'm talking about companies like Coca-Cola, which Warren Buffett, and I've known Warren for over 20 years, which Warren calls his favorite stock. Coca-Cola has paid dividends for over 100 years. Over 100 years. Think about that. Through 2 world wars, through the Great Depression, through every crisis you can imagine, Coca-Cola has been putting money into shareholders' pockets. Here's why dividend-paying stocks are perfect for retirees. First, they provide income. Real income that you can count on, income that tends to grow over time as companies increase their dividends. Second, they provide some protection against inflation. As costs go up, profitable companies can usually raise their prices, which means their profits go up, which means their dividends can go up. I remember having a conversation with Peter Lynch. You know Peter, he ran the Fidelity Magellan Fund. Peter told me something that I've never forgotten. He said, "The stock market is a voting machine in the short run, but it's a weighing machine in the long run." What he meant was that in the short term, stock prices are driven by emotion, by fear, and greed. But in the long run, stock prices are driven by fundamentals, by earnings, by dividend payments, by real business results. When you own dividend-paying blue-chip stocks, you're not betting on market sentiment. You're not trying to guess what other investors are thinking. You're partnering with profitable businesses that send you checks every quarter. That's beautiful. That's elegant. That's what retirement investing should look like. Now, how much should you have in dividend stocks? I recommend at least 40% of your retirement portfolio, 40% minimum. Some of my clients have as much as 60% in dividend-paying stocks, and they sleep like babies. They wake up every morning knowing that whether the market is up or down, their dividend checks are still coming. The second must-own investment for retirees is high-quality bonds, but not just any bonds. I'm talking about government bonds, high-grade corporate bonds, maybe some municipal bonds if you're in a high tax bracket. These are the foundation of every successful retirement portfolio. Let me tell you why bonds are so important for retirees. Bonds provide stability. When the stock market is going crazy, when cryptocurrency is crashing, when gold is falling, bonds just keep chugging along, paying interest like clockwork. They're the ballast in your portfolio, the steady foundation that everything else is built on. I learned about the power of bonds from my mentor, James Mitchell. James was running fixed income investments for one of the big insurance companies back in the 80s. He taught me that bonds aren't exciting, bonds aren't sexy, but bonds are essential. He used to say, "The stock market is where you make your money, but the bond market is where you keep your money." Here's what happened during the 2008 financial crisis. The stock market fell by over 50%. 50%. But high-quality government bonds actually went up in value as investors fled to safety. If you had owned a balanced portfolio of stocks and bonds during that crisis, your losses would have been much, much smaller than if you had owned only stocks. And bonds provide something that's absolutely crucial for retirees: predictability. When you buy a 10-year Treasury bond yielding 4%, you know exactly how much income you're going to receive for the next 10 years. Exactly. There's no guessing, no hoping, no crossing your fingers. That kind of predictability is worth its weight in gold, especially when you're living on a fixed income. Now, I know what some of you are thinking. You're thinking, but bond yields are so low. How am I supposed to make money in bonds? Well, let me tell you something. Bond yields today are actually quite attractive compared to what they've been for the past decade. 10-year Treasury bonds are yielding over 4% as I speak. 4%. That's more than double what they were yielding just 3 years ago. And remember, when you're retired, you're not trying to hit home runs. You're not trying to double your money in 5 years. You're trying to preserve your capital and generate steady income. A 4% return from high-quality bonds is beautiful. It's safe, it's predictable, and it allows you to sleep at night. How much should you have in bonds? I recommend at least 30% of your retirement portfolio, maybe as much as 50% depending on your risk tolerance. I have clients in their 70s who have 60% of their money in bonds, and they're doing just fine. They're traveling, they're spoiling their grandchildren, they're living the retirement they always dreamed of. The third must-own investment, and this might surprise some of you, is real estate investment trusts, REITs. REITs allow you to own a piece of commercial real estate without having to buy, manage, or maintain actual properties. They're traded on the stock exchange just like stocks, but they're required by law to pay out at least 90% of their taxable income as dividends. I've been investing in REITs for over 20 years, and I wish I had started earlier. Here's why REITs are perfect for retirees. First, they typically pay much higher dividends than regular stocks. Many REITs yield between 4 and 7% annually, 4 to 7%. That's income you can count on. Second, REITs provide inflation protection. When inflation goes up, rents go up. When rents go up, REIT profits go up. When profits go up, dividends go up. It's a beautiful cycle that protects your purchasing power over time. I remember back in the late 90s, I was having lunch with Sam Zell. Sam is one of the smartest real estate investors I've ever known, and Sam told me something that stuck with me. He said, real estate is the one asset class that people can't do without. They might stop buying cars, they might stop going to restaurants, but they still need somewhere to live and work. That's the beauty of real estate. It's essential. But here's why REITs are better than owning rental properties directly. When you own a rental property, you're responsible for maintenance, for finding tenants, for dealing with midnight phone calls about broken water heaters. When you own REITs, professional management teams handle all of that for you. You just collect the dividends, and REITs are liquid. If you own a rental house and you need money quickly, you might have to wait months to sell it. But if you own REIT shares, you can sell them any day the market is open and have your money in 3 business days. Now, not all REITs are created equal. I focus on REITs that own essential properties: apartment buildings, office buildings in good locations, shopping centers anchored by grocery stores, warehouses, data centers. These are properties that people need regardless of economic conditions. I avoid REITs that own hotels because hotel income is too volatile. I avoid REITs that own retail properties because retail has been struggling for years, and I don't see that changing. I focus on boring, essential real estate that generates steady income year after year. How much should you have in REITs? I recommend about 10 to 20% of your retirement portfolio. REITs are more volatile than bonds, but less volatile than regular stocks, so they provide a nice middle ground. And the income they generate, the steady quarterly dividends, can make a real difference in your retirement lifestyle. Let me tell you a story about one of my clients, Margaret Thompson. Margaret is 74 years old, retired from teaching high school mathematics for 42 years. When Margaret first came to see me 6 years ago, she had about $900,000 saved up. Not bad for a teacher, but she was worried. She was worried about inflation, worried about outliving her money, worried about maintaining her standard of living. We restructured Margaret's portfolio according to these principles I'm sharing with you tonight. 50% in dividend-paying blue-chip stocks, 30% in high-quality bonds, and 20% in REITs. Today, Margaret's portfolio is worth about $1.1 million, even after she's been taking out $60,000 a year to live on. $1.1 million. Her portfolio has actually grown while she's been spending from it. But more importantly, Margaret is happy. She's relaxed. She's not checking stock prices every day. She's not worried about market volatility. She receives about $50,000 a year in dividends and interest, and she only needs to sell about $10,000 worth of investments annually to meet her living expenses. That's sustainability. That's what a successful retirement looks like. Now, let me address something that I know some of you are thinking about. What about the fees? What about the taxes? These are important considerations, and I want to be completely transparent with you. When it comes to fees, the key is to keep them low and make sure you're getting value for what you pay. If you're working with a financial advisor, and I think most retirees should, make sure you understand exactly what you're paying and what services you're receiving. A good advisor should more than pay for themselves through better investment selection, tax planning, and helping you avoid costly mistakes. For taxes, the beauty of dividend-paying stocks and REITs is that much of their income is taxed at favorable rates. Qualified dividends are taxed at capital gains rates, which are lower than ordinary income rates for most people. And if you hold these investments in tax-advantaged accounts like IRAs or 401ks, you can defer taxes on the income until you withdraw the money. Municipal bonds can be particularly attractive if you're in a high tax bracket, because their interest is typically exempt from federal income taxes and sometimes state taxes too. The key is to work with a qualified tax professional who understands retirement taxation and can help you optimize your strategy. Here's something else I want you to think about, something that most people don't consider: the sequence of returns risk. This is a fancy term for a simple concept. The order in which you experience investment returns matters enormously when you're taking money out of your portfolio. If you have a bad year in the market early in your retirement, when your portfolio is at its largest, that bad year can have a devastating effect on how long your money lasts. But if you have a bad year later in retirement, when your portfolio is smaller, the impact is much less severe. This is why the stability provided by bonds and the steady income provided by dividend stocks and REITs is so important. They help smooth out the volatility. They help protect you from that sequence of returns risk that can destroy a retirement plan. Let me give you a concrete example. Imagine two retirees, both starting with $1 million. Both need to withdraw $50,000 a year to live on. Retiree A experiences 3 bad years in the market right at the beginning of retirement, then has good years after that. Retiree B has the exact same returns, but in reverse order. Good years first, then bad years later. Even though both retirees had identical investment returns over the long term, retiree A runs out of money much sooner than retiree B. That's the sequence of returns risk, and it's why you need stability and income in your retirement portfolio. The 3 investments I've recommended tonight: dividend-paying stocks, high-quality bonds, and REITs, they work together to provide that stability and income. They're not exciting, they're not going to make you rich quick, but they're going to help ensure that you don't run out of money in retirement. And let's talk about something that's on everyone's mind these days: inflation. Inflation is the silent killer of retirement portfolios. It doesn't make dramatic moves like the stock market, but it steadily erodes your purchasing power year after year. What costs $1 today will cost $1.20 in 5 years if inflation averages 4% annually. This is why you can't just hide your money in a savings account or in CDs. Cash and fixed-rate investments lose purchasing power over time when inflation is running higher than the interest rate you're earning. You need investments that can grow with inflation, and that's exactly what dividend-paying stocks and REITs provide. Companies like Coca-Cola, like Johnson & Johnson, they can raise their prices when inflation goes up. They can increase their dividends to help their shareholders maintain purchasing power. Real estate rents tend to go up with inflation too, which means REIT dividends tend to keep pace with rising costs. Even bonds, if you buy them at the right time, can provide some inflation protection. If you buy bonds when interest rates are rising, you can reinvest the interest payments at higher and higher rates, which helps offset the effects of inflation. I want to share one more story with you before we wrap up tonight. This is a story about the power of patience and the importance of staying disciplined with your investment approach. Back in 2000, I had a client named Robert Chen. Robert was a successful engineer who had just retired from IBM at age 64. He had accumulated about $1.8 million in his 401k and other accounts. Robert was a smart guy. Really smart guy, but he was also stubborn. He wanted to keep most of his money in technology stocks because that's what had made him successful during the 90s. I tried to convince Robert to diversify, to move some of his money into dividends and bonds, but he wouldn't listen. He was convinced that technology stocks were the future, and he didn't want to miss out on any potential gains. So against my better judgment, I helped him maintain a portfolio that was about 80% technology stocks. Well, you probably know what happened next. The dot-com crash of 2000 to 2002 wiped out over 70% of Robert's portfolio. 70%. By 2002, his $1.8 million had shrunk to about $500,000. Robert was devastated. He was angry, he was scared, and frankly, he was angry at me too, even though I had advised against the strategy he insisted on pursuing. But here's the interesting part of the story. Instead of panicking, instead of selling everything and hiding the money under his mattress, Robert finally listened to my advice. We restructured what was left of his portfolio according to the principles I've shared with you tonight. Dividend stocks, bonds, REITs. We focused on income and stability instead of growth and speculation. Over the next 15 years, from 2002 to 2017, Robert's portfolio not only recovered, it grew to over $1.2 million. $1.2 million. And during those 15 years, he was withdrawing $70,000 annually to live on. His portfolio grew while he was spending from it, just like Margaret's portfolio that I mentioned earlier. Robert is 79 now, and he's doing well. He learned a very expensive but very valuable lesson about the importance of diversification and the power of focusing on income rather than speculation. He wishes he had listened to me sooner, but he's grateful that it wasn't too late to change course. The moral of Robert's story is that it's never too late to make smart decisions with your money. It's never too late to prioritize stability over speculation, income over growth, peace of mind over the thrill of potentially hitting it big. As we get older, our relationship with money needs to change. When we're young, we can afford to take risks, we can afford to lose money and make it back, we have time on our side. But when we're over 65, time becomes our scarcest resource. We can't afford to spend 10 or 15 years recovering from major losses. That's why the 3 investments to avoid, cryptocurrency, individual growth stocks, and gold, they're all about speculation, about hoping that someone else will pay more tomorrow than you paid today. That's not a strategy, that's gambling. And that's why the 3 investments to own, dividend-paying stocks, high-quality bonds, and REITs, they're all about generating income, about partnering with profitable businesses, about owning assets that produce cash flow, regardless of what other investors are thinking or doing. I want to leave you with one final thought tonight, one final piece of advice that I think is more important than any specific investment recommendation. The most important thing you can do for your financial security in retirement is to live below your means. Live below your means. I don't care how much money you have. I don't care how good your investments are. If you're spending more than your portfolio can sustainably generate an income, you're going to have problems. The math is unforgiving. If you need to withdraw more than about 4% of your portfolio value annually, you're probably withdrawing too much. This might mean making some lifestyle adjustments. It might mean downsizing your house, driving your car a little longer, eating out a little less frequently. But these small sacrifices are nothing compared to the peace of mind that comes with knowing your money will last as long as you do. The goal of retirement investing isn't to get rich. The goal is to stay rich, to preserve the wealth you've already accumulated, and to generate enough income to maintain your standard of living for the rest of your life. It's about sleeping well at night, about not having to check your account balances obsessively, about being able to enjoy your golden years without constantly worrying about money. The 3 investments I've recommended tonight, dividend-paying stocks, bonds, and REITs, they may not be glamorous, they may not make for exciting dinner party conversations, but they work. They've worked for my clients, they've worked for me, and they can work for you too. Thank you for your attention tonight. I hope this information serves you well, and I hope your retirement years are everything you've dreamed they would be. Remember, it's not about timing the market, it's about time in the market with the right investments. Good luck and good night.